The U.S. labor market showing resiliency as the economy added 339,000 jobs last month, blowing past expectations. However, the latest numbers do little to clarify the Fed debate over whether to pause rate hikes in June. This all while the Fed continues in its efforts to cool inflation. Here with a deeper dive on the current economic picture is Nationwide Chief Economist Kathy Bostjancic. Kathy, let's get right into this. First, let's do like a fresh analysis. How do you read the tea leaves on this jobs report? Of course, we had the household and establishment survey. One side looking great, the other side. What's your take?
Yeah, happy to be with you, Dan. It can be confusing. Clearly, they are two different surveys. The non-farm payroll, though, in terms of the employment count, tends to get more attention, and it should. It's a bigger survey and more stable. And that said, when the two surveys disagree or there's a conflict, sometimes that's a sign of a turning point. That said, it looks as if the labor market still remains incredibly strong. The number of job gains, and it was widespread. And wage growth, even though the headline number, which includes all workers, was up just 0.3 on the month and allowed the year-on-year rate to ease a bit to 4.3% before 4. If you look at production and non-supervisory workers, it was up 0.5%. So that's quite strong. And the year-on-year remained at 5%. So there's still a lot of wage gains, especially with, the non-supervisory workers. And they're, really spending, right? We're seeing consumer spending remain quite buoyant.
So, Kathy, then what does this mean for the Fed? It sounds like, at least maybe from your perspective, that it could possibly make sense to hike later this month. Is that right?
It could, although, they are supposed to be data dependent. If we just look at the data that have been released, that would argue for tightening rates on June 14th. Now, of course, we will get the June CPI inflation report, so that's important, and it makes sense to wait to see what that is. But really what Fed officials have come out and said mostly is that they're looking to skip a meeting and if need be tighten in July. So they really came out of the last meeting thinking they wanted to pause and the data have gone against them essentially, and they haven't really wanted to change their viewpoint. They want to assess the economic landscape and see more data. That puts it out of the data dependency, right? We're now living by their short-term guidance.
Kathy, I want to ask you, one piece of the report that stood out to me was the black unemployment rate, which rose to 5.6%. So that pushed up the overall unemployment rate. Is there cause for concern seeing a number like that?
Well, when you do see increases in unemployment rate, whether it's different demographic sectors, which of course matters greatly, or even just the overall number, which went up 0.3, that historically has been consistent with recession. But we've been in this range, a lot of those measures, even for Black Americans, that unemployment rate has sort of been in this range, since if we go back to early last year. So it's not alarming at this point. And I think what we're seeing from other measures like the job openings data, that there's still just a lot of demand for workers. And maybe it's pulling them. Maybe they're unemployed, but it's very temporary because they can then quickly find another job. Maybe not exactly what they were doing before, but maybe on the service side of the economy.
Kathy, is there anything recessionary about this print?
Well, I think you really have to stretch to get there. I would say overall, no. I would say that, employment, shows that we are not in recession, and not about to go into recession. Now, keep in mind, though, the employment measure and job growth is a coincident indicator. Initial jobless claims are really the leading indicator. But even there, we're not seeing a lot of weakness. The labor market's slight, but not a lot. So, I think what it does is tell us that we're probably going to have strong growth through even the third quarter. And we have to look to the fourth quarter. We haven't abandoned our call for recession, but we do think it's delayed. And because these leading indicators still indicate an economic downturn, and these are try and true indicators, but for the meantime, this job producing engine is still really humming along.
So, Kathy, you said you haven't abandoned that kind of base case expectation for a recession. But you're seeing it as delayed. Is this a 2024 expectation now?
It is tough to call the timing just because we in the forecasting, economic profession have really been surprised by the staying power of the labor market. And therefore that feeds into consumer spending. But our view is, by the fourth quarter, we'll start to see some of the cracks emerge and the recession start. We do think what we're seeing is this kind of last blow off of buoyancy in the labor market and consumers because the summer travel season particularly is heating up. So and there's also all that pent up demand and also savings that were accumulated during COVID and related to COVID. So for now, you still have that staying power. But as long as inflation continues to only gradually slow, and let's keep in mind, even if the Fed skips June, they could come back in July and tighten, and that's going to raise borrowing costs for consumers and businesses.
Okay, well, to skip, pause, or hike, that remains the question. We'll certainly see if there's a summer surge that changes anything within that picture. Thank you so much, Kathy Bostjancic, Nationwide Chief Economist, for joining us this Friday. Happy Friday.